On Wednesday, Commonwealth Bank shares hit a record $181.10 to become the first ASX-listed company to be valued at more than $300 billion. By comparison, the country's second largest company, BHP, has a market capitalization of $192 billion. The iron ore giant has been the ASX biggest stock since it collapsed its British company, but was overtaken by the bank in July last year, when both had market capitalizations around $220 billion. Although the bank's share price eased a little by Friday, it still makes CBA one of the most expensive bank stocks in the world, well above Wall Street giant JP Morgan and British lender Lloyds Bank, which is a similar annual profit, but a valuation that's about 1/3 of its ASX-listed peer. But why is the value so high? That is indeed the question. On Wednesday, CBA shares were trading at more than 31 times what the markets expect will be its earnings next year. That's almost double the 2-decade average. That means investors are paying twice as much for the same dollar of profits as they've done in the past. That on a comparable basis, Australian banks in Australia are able to charge high rates and make much higher margins than international peers due to the lack of true competition and intrinsic government support. And no, they're not in the forefront of AI, as some are speculating. And in a global context, relative to its peers and its history, CBA's share price is extreme. The 31 times valuation is on par with some of the so-called Magnificent Seven tech giants like Apple and Meta. So the question becomes, is the concentration of money pushing the CBA through the $300 billion barrier really a sign of a healthy market? And is it sustainable, or are we in bubble territory?